BRRRR, how many people in here BRRRR the house? Okay. I know we got a couple investors in, high-level investors that's doing this strategy. This is one of the best strategies to build wealth because you're able to, the money that you're able to put in up front, you're able to extract this money out and still own the deal. With this strategy, essentially, it's a flip. You go through, you find a house that needs work, and then from there, you put the work in it, but instead of selling it and flipping it, you go to the bank that you built a relationship with, local bank, community bank, credit union, and you tell them, hey, I want to keep this and refinance my short-term loan, whether I went through a private lender, a hard money lender, or you borrowed money from somebody else's self-directed IRA to do the renovations and purchase the house, and now you go and just refinance the property. And normally they'll refinance it at 75% of the new value or 80% of the new value. And guess what? If we did the math and we kept to our numbers when we did the same thing that we do with a flip, we're all in on the deal, 75%. So guess what? If you get a 75% loan and you only spent 70% of the after repair value, you're gonna get 5% back at closing. That literally you do a deal, fix it up over 2 months and refinance it, and you get paid at the closing table, get all your money back to deal, pay off your short-term loan that you had, and now it's renting out. You're bringing in whatever, $500-600 a month cash flow, and you got no money in the deal, and you still had 25% equity left. And so that's the powerful strategy, where is that once you can find these deals, and if you do 4 deals a year, and if you say you got a $100,000 house, and you got a 75% loan, now you got $25,000 in each house that you buy. If you do this 3-4 times a year, that's $75,000 to $100,000 of equity that you built up in 1 year with no money left in the deal. And that's equity and that's wealth that you're building up over time. And guess what? You keep doing that 5-7 years from now, and if you're doing, we'll say you do 2 deals a year for 7 years, that's 14 houses. And then guess what? After you get to year 5, the ones that you bought in year 1, you go and refinance that one. Then in year 6, the one you bought in year 2, you go refinance that one. And you just stagger it. And that's one of the strategies that a lot of the wealthy use. They use it for apartment building. Because as they go through, because rents are going up, the Fed says they want to keep inflation at 2%. So in 10 years, your money is going to be worth 20% less. If they keep it at 2%, they want to keep it at 2%, but right now it's at 7%. So if they don't get inflation down, 10 years, your money is going to be worth 70% less. And guess what? Real estate is going to be costing 50 to 70% more. Y'all see that relationship with the inflation and how you're losing buying power? And by owning assets, it takes more of those dollars that's worthless to buy your real estate, to buy your assets that you own. And so that's just one of the strategies where you can get in and pull all your money out of these houses, and then over time, as they go up in value and they're paying, your tenants and your residents are paying down your mortgage, you're getting depreciation, that's taking money off taxes that you have to pay, and they're paying down the mortgage, and it's going up in value over time. And that's why real estate is a great hedge for inflation. And you see a lot of these hedge funds and Wall Street money managers that had billions of dollars. Why, when we had the CARES Act with COVID, and they printed all this money, they printed 50% of all. So but for pre-COVID, however many trillions and trillions of dollars were in circulation, they printed half of that amount in less than 2 years. So they a 50% increase in the amount of money, of US dollars that were floating around. And so that's why you had all these Wall Street hedge funds and everybody, they started buying real estate because they already know if you put this much money into circulation that everything's gonna go up. Debt was cheap. You could buy a house and get a 2% interest rate if you bought the rate down. It was crazy. So they already knew what was gonna happen with all this money being in there, that inflation was gonna shoot up. And so what did? They started buying real estate everywhere, buying houses by the hundreds. In cities like Boise, Phoenix, Austin, and areas like that. Atlanta was a big one where you had a lot of the iBuyers, Open Door, Zillow, where they were buying these houses because guess what? The money they were borrowing on Wall Street, they weren't paying but 2-3% interest on it. And so now they can go buy it and they know they're going to make 10-12% return on the rent that they were getting. And so that's the game that they're playing at a really, really high level. And so that's with the BRRRR strategy, it allows you to to take these houses, but instead of flipping them and then having to worry about paying the taxes because you owned it less than a year, now you're adding this to your portfolio. And this is how you build wealth and start building wealth at a fast level. Because if you can really get good at finding deals or align yourself with a partner that can find deals off market, and you're able to turn these houses over, that you can build wealth fast. You just do this 5 years. You know, you buy 4 houses a year for 5 years, that's 20 houses. And if you got 20 houses and you're making $400 a house, that's what, $8,000? And all those mortgages are being paid down each month. You're getting equity, all the depreciation for the write-offs. I think for the apartments that we bought this year, we did a cost segregation study, and I think we're going to have a depreciation loss on paper between $800,000 and $900,000 for the investors. It's like 5 of us in the deal that we're going to split up. And guess what? That's how Donald Trump doesn't have to worry about paying taxes, because he owns a lot of real estate. And they own their partners in these deals. They own skyscrapers and all these commercial buildings where all this depreciation and everything, that it's a loss. And then when they sell it and they try to recoup and charge the taxes, they just go buy another piece of another asset with it, and then they don't have to worry about it because it's deferred. And then they just defer it property to property to property. Sell a property 20 years later, then move it, and you go buy another. And you don't have to worry about paying taxes. And that's how they build wealth over time, whereas that you can defer all those taxes, and then once you get down the line and you pass away, it's in a trust. The trust owns it. It's no taxable event, and the family just owns it and keeps on going and keeps on trucking. And so that's the thing that we're talking about with these different strategies.